Money is more about behavior than knowledge. Most people think money is about math, numbers, formulas, investment strategies. But Morgan Housel argues something different. Money is mostly about behavior, not intelligence. You don't need to be a genius to manage money well. Instead, you need discipline, patience, and emotional control. Two people with the same knowledge can have completely different financial outcomes because they behave differently. No one is crazy. When it comes to money, everyone has their own perspective. Housel explains that what seems irrational to one person often makes perfect sense to someone else. Why? Because everyone's financial decisions are shaped by their unique experiences. For example, someone who grew up during a recession may be extremely cautious with money, saving obsessively and avoiding risk. Someone who grew up seeing their parents take calculated risks may be comfortable investing in volatile markets. Both behaviors are understandable, even if they seem extreme to others. Our past experiences act as a lens through which we view money. No one is completely crazy. We just react to the world we've known. Housel emphasizes that judging others' financial choices often misses this context. People are making the best decisions they can with the knowledge and experiences they have. Key takeaway. When you understand this, it becomes easier to be patient with your own mistakes, avoid envy, and recognize that different paths can lead to success. Everyone is doing the best they can with what they know, and that's the first step to smarter financial thinking. Luck and risk. Morgan Housel points out that money and success are never fully in our control. Luck and risk play a huge role in shaping outcomes, sometimes more than talent or hard work. For instance, a successful entrepreneur might seem like they earned it all, but timing, chance opportunities, or being in the right place at the right time often played a big role. Conversely, someone who fails may have done everything right but faced circumstances beyond their control, like an economic downturn. This is why comparing yourself to others can be misleading. What looks like skill might actually include a lot of luck, and what looks like failure might hide careful decisions that just didn't pay off due to circumstances. Key takeaways. Be humble in success. Luck probably helped more than you realize. Be empathetic in failure. People often make reasonable decisions even if the results are bad. Plan for uncertainty. Always leave room for the unexpected in your financial decisions. Understanding luck and risk teaches patience, humility, and the importance of avoiding unnecessary exposure to loss. Never enough. Morgan Housel warns that chasing more than enough is one of the biggest traps in money and life. Many people think the solution to happiness or success is always more. More money, more status, more possessions. But the problem is, wanting more can lead to unnecessary risk, stress, and even ruin. Example. Someone might continue investing aggressively to get richer even after reaching financial security and end up losing it all. Another might keep comparing themselves to wealthier peers, feeling inadequate no matter how much they earn. Housel emphasizes that knowing what enough looks like is a powerful skill. It lets you avoid reckless risk-taking, feel content with what you have, and focus on the freedom and security that real wealth provides. Success is not about maximizing income forever. It's about knowing when you have enough and using what you have wisely. Key takeaways. Define enough for yourself. Don't let comparison guide your choices. Avoid overreaching. Chasing endless wealth can destroy what you already have. Appreciate what you have. Contentment is a major factor in long-term financial happiness. Understanding enough helps you make smarter decisions, protect your wealth, and maintain peace of mind. Compounding is the key. Morgan Housel highlights that wealth grows slowly at first, then accelerates dramatically over time, all because of compounding. Compounding isn't just about money, it's about results building on results. A small action repeated consistently can lead to extraordinary outcomes. Example: Warren Buffett didn't get rich overnight. He invested steadily over decades, allowing small returns to compound into billions. A modest $100 invested regularly in a stock index fund can grow to hundreds of thousands if given enough time. The key is patience. Most people underestimate how powerful time is and overestimate what can happen in the short term. Key takeaways: start early. Time is your greatest advantage. Consistency beats intensity. Regular small actions matter more than sporadic big wins. Avoid the temptation to move fast. Compounding rewards those who stay invested and disciplined. Compounding works quietly in the background. The secret to wealth isn't a single huge payoff. It's the accumulation of small, smart choices over years. Getting wealthy versus staying wealthy. Morgan Housel explains that making money and keeping money require completely different skills. Getting wealthy. To build wealth, you often need risk-taking, investing in opportunities with potential high reward. Optimism, believing your actions can pay off. Action, taking steps others might avoid. This is how people accumulate money in the first place. Staying wealthy. Once you have wealth, preserving it becomes the priority. This requires caution, avoiding unnecessary risks, patience, letting investments grow steadily, humility, recognizing luck and avoiding overconfidence. Many people fail because they excel at one but not the other. They take risks to get rich, then fail to protect what they've gained. Key takeaways: accumulation and preservation are different games. Know when to take risks and when to be conservative. Avoid arrogance. Wealth can disappear quickly if you forget about risk. Think long term. Your goal is not just to get rich, but to stay rich. In short, getting wealthy is about boldness. Staying wealthy is about discipline and prudence. Both are essential for lasting financial success. Tail events matter. Morgan Housel emphasizes that a small number of events often drive the majority of financial outcomes. These are the tail events, rare but extremely influential moments that shape wealth and success. Example: in investing, a few big winners can create most of your portfolio's returns. A handful of stocks often account for the majority of gains. In business, a single decision or opportunity can determine success or failure. The important lesson is that you don't have to be right all the time. Success often comes from a few extraordinary wins combined with avoiding catastrophic losses. Key takeaways: focus on what matters most. Not every decision needs to be perfect. Avoid big mistakes. Preventing disasters is often more important than chasing small wins. Patience pays off. Compounding tail events over time is what builds extraordinary results. Tail events remind us that wealth isn't just about steady effort. It's about recognizing rare opportunities, taking advantage of them, and protecting against disasters. Freedom is the real goal. Morgan Housel argues that the true value of money isn't luxury or status, it's freedom. Wealth allows you to control your time, choose what you work on, choose when you work, choose who you work with. This freedom is far more valuable than flashy possessions or expensive lifestyles. People often chase money to impress others, but real wealth is quiet and personal. Key insights: time is priceless. Money's greatest benefit is the ability to spend it on what matters to you. Avoid lifestyle inflation. More money doesn't automatically create happiness if it's spent on things that don't give you freedom. Prioritize control. Focus on earning and saving in ways that increase flexibility in your life. In essence, financial success isn't about showing wealth, it's about gaining the freedom to live life on your own terms. The power of saving. Morgan Housel emphasizes that saving is more important than earning. You don't need a huge income to build wealth, you need discipline and consistency. Saving gives you options, the ability to invest, the freedom to take risks, protection against unexpected emergencies. Housel points out that wealth is often invisible. It's not about flashy cars or luxury items. True wealth is what you don't see. Money quietly accumulating in savings and investments over time. Key takeaways. Pay yourself first. Prioritize saving before spending on non-essential items. Consistency beats income size. Small, repeated savings grow into significant wealth over time. Use savings as flexibility. It gives you control over your choices and protects against life's uncertainties. Remember, wealth isn't just what you make, it's what you keep. The discipline to save consistently is one of the most powerful financial habits you can develop. Reasonable versus rational. Morgan Housel explains that trying to be perfectly rational with money often doesn't work because humans are emotional beings. Instead, it's better to focus on being reasonable, making decisions you can stick with over the long term. Example, a perfectly optimized investment strategy might earn slightly higher returns, but if it's stressful or too complex, you may abandon it. A simpler, reasonable plan that aligns with your behavior is more likely to succeed. Housel stresses that financial success is less about math and more about psychology. Your ability to maintain habits, handle uncertainty, and stay disciplined often matters more than having perfect knowledge. Key takeaways. Choose strategies you can follow. Consistency is better than perfection. Avoid complexity that causes stress. It can lead to poor decisions or abandonment. Focus on behavior, not theory. Your actions over time determine outcomes. In short, reasonable financial decisions you can sustain are far more powerful than theoretically perfect decisions you can't. Long-term thinking. Morgan Housel highlights that most financial success comes from thinking long-term, even when short-term results are unpredictable. Humans are wired for instant gratification, which makes it tempting to chase quick wins or react emotionally to market swings. But Housel stresses that wealth grows steadily when you stay patient and consistent. Example, investors who panic during a market downturn often sell at the worst moment. Those who stick to a long-term plan, even through volatility, see compounding work in their favor. Long-term thinking also means focusing on durability rather than flashy, high-risk opportunities. Success is rarely instant. It's the accumulation of smart decisions over decades. Key takeaways. Patience beats speed. Allow your investments and savings to grow over time. Avoid emotional reactions. Don't let fear or greed dictate financial decisions. Focus on the big picture. Small fluctuations rarely matter in the long run. In essence, the secret to lasting financial success is thinking in decades, not days. Long-term consistency always outperforms short-term excitement. The role of ego. Morgan Housel explains that ego can be a major obstacle to financial success. Many people spend money or take risks to impress others rather than to build true wealth or security. Example, buying a flashy car or luxury item to appear successful. Investing in a hot stock because everyone else is doing it. These actions often backfire, creating stress, debt, or losses. Housel emphasizes that real wealth is quiet, not flashy. The people who achieve lasting financial security often live below their means and avoid status-driven spending. Key takeaways: avoid lifestyle inflation. Don't let ego dictate spending habits. Focus on hidden wealth. True financial strength comes from assets, savings, and investments. Measure success by freedom, not appearance. Wealth should serve you, not impress others. The key lesson: the less you care about what others think, the more control you have over your financial life. Ego-driven decisions are the fastest way to sabotage long-term wealth. Room for error. Morgan Housel emphasizes that always leaving room for mistakes is essential in money management. The future is unpredictable, and things rarely go exactly as planned. Example: a sudden market crash or economic downturn can wipe out investments if you've taken too much risk. Unexpected life events like medical emergencies or job loss can derail financial plans. By planning for the unexpected, you protect your wealth and reduce stress. Saving extra, avoiding over-leverage, and keeping a margin of safety allows you to weather storms without major setbacks. Key takeaways: expect uncertainty. Don't assume everything will go perfectly. Leave a margin of safety. Savings and diversification act as buffers. Avoid overconfidence. Even the best plans need backup. In short, room for error isn't a sign of weakness. It's a critical strategy for long-term financial survival and success. You'll change over time. Morgan Housel reminds us that your goals, priorities, and desires will evolve over your life. What seems important at 25 may not matter at 45. Example: early in your career, you might prioritize high income and fast growth. Later, you may value stability, flexibility, or time with family more than salary. Financial plans should reflect this reality. Being too rigid can lock you into paths that no longer serve you. Flexibility allows you to adapt to changing circumstances and evolving goals. Key takeaways: expect change. Your financial needs and ambitions will shift over time. Build adaptable plans. Avoid decisions that are irreversible or overly restrictive. Focus on long-term alignment. Let your financial strategy evolve with your life. Understanding that you'll change helps you make smarter, more sustainable financial decisions that work for the person you are now and the person you'll become. Conclusion: the real lessons of money. The psychology of money teaches that wealth is built through behavior, not intelligence. Consistency matters more than brilliance. Patience is more powerful than speed. Avoiding mistakes is more important than chasing wins. Freedom is the ultimate goal of money. Final reflection. Money is not just numbers on a screen. It's about how you think, how you act, how you handle uncertainty. And in the end, the people who succeed financially are not the smartest. They're the ones who stay consistent, patient, and in control of their behavior.